This chart shows the growth of $100 in the S&P 500 since 1980. If you are new to investing and you bought into an S&P 500 index fund, no one blames you for thinking that this is what you're going to get. But what if I told you that this is what you could get? This is the S&P 500 total return over the same time period. At the end of this time period, your account value could be 3 times greater than the S&P 500. So how can that be? Well, it turns out that when you invest in an index fund or an ETF that tracks the S&P 500, you're not necessarily stuck with where the S&P 500 is going to take you. Not necessarily. And the great thing is you can take steps to optimize and boost your growth. In this video, I'm going to talk about how your index fund can beat its own index. There's 2 important decisions that you need to carefully consider. You need to decide what you're going to do with your dividends and how you're going to minimize your taxes. These, along with the expense ratio, will determine your actual returns above and beyond the S&P 500. These decisions aren't really complicated. It's not rocket science, but they have some big consequences that you might not be fully aware of. And so whether you're just getting started with index funds or you've been at it for a while, I hope that this video helps you become a better index fund investor. Even though I'm focusing this video on the S&P 500 index, the concept still applies to most other equity index funds and the indices they're tracking. But if you think there's something I missed that I should have mentioned, definitely let me know down in the comments below. Let's first talk about dividends. Currently, the dividends for virtually all S&P 500 index funds and ETFs land somewhere between 1.5% to 2%. And that's not saying much on the face of it, considering the annual US inflation rate roughly cancels out those gains. More often than not, you don't buy index funds for the dividends, you buy for the capital appreciation. The dividends are a nice to have or just an afterthought for most investors, but most investors underestimate just how much reinvesting the dividends back into the S&P 500 can accelerate their returns because of compounding. Compounding is where you continue to receive dividends from your initial investment, but over time, the dividends that you've already earned start making dividends themselves. And so instead of a simple linear growth pattern over time, you get an exponential growth over time. And I think the best way to show this is through a simple example. Say you own a stock of Tesla represented by this Model 3, and let's just pretend it pays you a dividend of 10% every month, which it doesn't, but we're just making it up for now. After 10 dividend payouts from that single Tesla stock, you can buy another Tesla stock. Now you have 2 that pay out 10% dividends. Now your dividends twice as fast and you can buy another stock in 5 months. With 3 stocks, you can buy another stock in just over 3 months. With 4 stocks, you can buy another in just 2.5 months. With 5 stocks now, you can buy another stock in just 2 months. And eventually you'll have 10 stocks and you can buy a new stock in 1 month. And then you'll start buying multiple stocks each month just with your dividends. And you can tell that this is going to keep going faster and faster and grow bigger and bigger. And we haven't even touched on the fact that each of your Tesla stocks could be growing in value during this entire time. Now, most stocks that you actually want to invest in don't pay a dividend of 10%. Long story short, any company that pays out a dividend that high probably cannot continue doing that for very long. And if we look at the average dividend of the S&P 500 over time, the one and only time it was above 10% was back in 1932. More recently, in the last 50 years, the dividend has been at or below 5%. In the most recent 10 years, between 2009 to 2019, the average dividend has been 1.97%. But regardless of what the actual dividend yield is, the exponential growth through compounding doesn't change, and you can take full advantage of it by reinvesting the dividends from your index fund back into it. But then you may be wondering, well, what exactly can you expect from doing that? And to answer that question, we have to go back in time to when the first index funds showed up. Jack Bogle created the first index fund back in 1975, which, as you would have guessed, tracked the returns of the S&P 500. This fund still exists today as the Vanguard 500 index fund. Assuming you had invested in this index fund since, let's say, 1980, here is how you would have performed. The S&P 500 price return was 760% between 1980 to 2020, adjusted for inflation. 445% in the 30-year period between 1990 to 2020, 53% between 2000 to 2020, and 152% in the last decade. If you had reinvested dividends since 1980, you would have grown your investment an additional 1,500%. That's right, a whopping 1,500% on top of the 760% price growth over 40 years. You would have an additional 450 50% if you start in 1990, 71% if you started in 2000, and an additional 54% if you started in 2010. For those who invested in passive index funds prior to passive investing becoming mainstream, it has worked out really well. But for the subset of those investors who reinvested their dividends, the results have been absolutely staggering. There are probably a few factors that really played into their favor, one of which was that their investments were front-loaded with higher dividend yields just as they started investing in the early 1980s. Yields of 5% or more were much more common back in those days than they have been since the 1990s. If we break out the share of total returns that can be attributed to dividends by each decade, the 1980s saw more than half the returns come in the form of dividends. Now, dividend yields have rebounded somewhat since the lowest levels seen around 2000, but still nowhere near the levels that the investors in the 1980s experienced. And since the 1990s, there's just been less shareholder emphasis on dividends and more on capital gains, such as during the dot-com bubble or in today's booming technology environment. But still, reinvesting your dividends makes sense if you really don't need the cash right now and or you just started investing. So that sounds all great, but then you may be wondering, well, how exactly do you go about setting it up? How exactly do you go about reinvesting your dividends? If you're investing through an employer-sponsored retirement plan, then most likely your 401k, your 403b, or 457 plan is automatically reinvesting the dividends for you. But I would call your HR just to confirm that's accurate. If you are owning index funds in a private brokerage account though, you may need to make the selections on your own in each of your accounts. If you have to have a private brokerage account with Fidelity, I'm going to show you real quick how to make your dividend reinvestment selections. So you would first go to Accounts and Trade, Account Feature. You would go to Brokerage and Trading, Dividends and Capital Gains. You would click Update for your account, Reinvest in Securities, select that bullet, and then you would press Update, and you're all set. And then make sure you press Submit. If you own index funds outside of a tax advantage account like a 401k or an IRA or an HSA, and you think dividend reinvesting is a good idea for your situation, then you also need to know that you may need to pay taxes, which would also reduce your total returns. And I want to explain that real quick. You will still come out ahead compared to the S&P 500, but both your dividends and capital gains that you earn will be taxed at the capital gains tax rate as long as you hold the fund for at least a year. If you hold it for less than a year, they will be considered less favorably as ordinary income from a tax perspective. So definitely you want to be committed for at least more than a year. And this is regardless of whether you decide to reinvest the dividends or not. There are other problems that you want to think about if you're wanting to hold index funds for only a short term. And I talk about it in more detail in this video right here. So be sure to check it out if you want to learn more. But going back to dividends and taxes, another thing that you want to keep in mind is that even though you don't plan on selling any of your shares, the fund itself may have to sell some of its holdings from time to time for a number of different reasons. And if it doesn't have any losses to offset those gains, then it has to distribute those gains to you as a shareholder, in which it will be taxed as capital gains. There are 3 capital gains tax brackets with a maximum rate of 20%, and the tax bracket that applies to you depends on your filing status and your income level. If you found this video helpful, be sure to hit that like button down below and be sure to subscribe and hit that notification bell so that you don't miss out on any future videos. Thanks for watching, and I'll see you guys next time.